When making a second home purchase, buyers need to ensure that they have enough money to cover not only the mortgage and interest payments, but also property taxes, insurance, utilities, and all other fees associated with the new property. Therefore, lenders often have more stringent standards for second home buyers. Typically, they will require that second home buyers meet higher credit score standards, have stronger debt-to-income ratios, make a larger down payment, and pay a higher interest rate than for a loan on a primary residence. Additionally, lenders might have requirements about the property being purchased, such as requiring that no more than 15% of condo owners in a development are behind on their association dues. If a second home's rental income is needed in order to qualify the buyer for a loan, the property, and therefore the loan, falls into the investment category. Lenders factor in the rental income, expenses, and mortgage payment when determining how large a loan can be approved. Investment loans generally carry higher interest rates and less attractive terms than vacation home loans because they are considered higher risk. If the buyer plans to rent the property in order to cover the mortgage payments, lenders will usually account for vacancies by allowing only 75% of any rental income to be considered. In reality, most owners who rent their resort properties will find that there is a very busy peak season for rentals, with shoulder seasons and an off-season when the property stands vacant. Some lenders offer the flexibility of seasonal loans with higher payments during the peak season when rental income is higher than during shoulder and low seasons. If rental income is not needed to pay the mortgage, terms should be the same as for a personal use vacation home. Second home mortgage rates increase. In April of 2022, the Federal Housing Finance Agency, FHFA, began charging new upfront fees for some high balance and second home loans sold to Fannie Mae and Freddie Mac. For second home loans, these fees will increase on a tiered scale between 1.125% and 3.875%, depending on loan-to-value ratio. This has increased the cost of financing second home properties for some buyers and may impact your vacation home clients. Instead of pursuing a conventional loan, they may opt to pay cash or get a home equity loan on their principal residence. Financing a second home involves obtaining a mortgage or other form of financing to purchase a property that you do not intend to use as your primary residence. Here are some important facts to consider when it comes to second home financing. 1. Higher interest rates. Mortgages for second homes typically come with slightly higher interest rates compared to primary residence mortgages. Lenders often view second homes as riskier because owners are more likely to default on payments for a secondary property if they encounter financial difficulties. 2. Down payment requirements. Lenders often require a larger down payment for second homes than for primary residences. The down payment requirement can vary, but it's common to see down payments ranging from 10% to 20% or more of the property's purchase price. 3. Credit score. Lenders will scrutinize your credit score and financial history when evaluating your eligibility for a second home mortgage. A strong credit score is essential to qualify for favorable terms. 4. Debt-to-income ratio. Lenders assess your debt-to-income ratio, which compares your monthly debt obligations to your income. They typically prefer a lower debt-to-income ratio when considering second home financing. 5. Use of the property. Lenders may ask about your intended use of the second home. If it's purely for personal use, you may qualify for different financing terms than if you plan to rent it out as an investment property. 6. Property location. The location of the second home can impact the financing terms. Some lenders may have restrictions or offer different rates for properties in certain areas, such as vacation destinations. 7. Tax implications. Owning a second home can have tax implications. You may be eligible for certain tax deductions related to mortgage interest and property taxes, but these deductions can be subject to limitations, so it's advisable to consult a tax professional. 8. Insurance costs. Insurance costs for a second home, especially if it's in a coastal or high-risk area, can be higher than for a primary residence. You may need additional coverage for rental properties or vacant second homes. 9. Loan types. There are various types of mortgage loans available for second homes, including conventional mortgages, FHA loans, VA loans, if you're a qualifying veteran, and jumbo loans, for higher-priced properties. The specific loan type you qualify for can depend on your financial situation and the property. 10. Rental income. If you plan to rent out the second home, lenders may consider potential rental income when evaluating your ability to repay the mortgage. However, rental income is typically not counted in its entirety, and lenders may apply various factors to it. 11. Regulations and restrictions. Be aware of any local regulations, homeowner association rules, or restrictions that may affect your ability to rent out the property or use it for certain purposes. It's crucial to work with a knowledgeable mortgage broker or lender who specializes in second home financing to navigate the complexities of securing a mortgage for your second property. They can help you understand the specific requirements, interest rates, and terms that apply to your situation and location.